Corporate bonds. Corporate bonds are debt instruments issued by private and public sector companies. They are issued for tenors ranging from 2 years to 15 years. The more popular tenors are 5-year and 7-year bonds. Most corporate bonds are issued to institutional investors such as mutual funds, insurance companies, and provident funds through a private placement of securities. Companies may also raise funds from the public by making a public issue of bonds where retail investors are called upon to invest. Bonds of all non-government issuers come under the regulatory purview of SEBI. They have to be compulsorily credit rated and issued in the demat form. The coupon interest depends on the tenor and credit rating of the bond. Bonds with the highest credit rating of AAA, for example, are considered to have the highest level of safety with respect to repayment of principal and periodic interest. Such bonds tend to pay a lower rate of interest than those that have a lower credit rating such as BBB, which are seen as having a high credit or default risk. All public issues of bonds have to be mandatorily listed on a stock exchange. A privately placed bond may also be listed on a stock exchange if it meets the listing requirements. Corporate bonds can be issued using various cash flow structures. A plain vanilla bond will have a fixed term to maturity with coupon being paid at predefined periods and the principal amount being repaid on maturity. The bond is usually issued at its face value, say, 100 rupees, and redeemed at par, the same 100 rupees. The simple variations to this structure could be a bond issued at a premium or discount to face value or redeemed at a premium or discount to face value. In some cases, the frequency of the interest payment could vary, from monthly, to quarterly and annual. Or, the bonds could feature a cumulative option where the interest is not paid out to the investor periodically but instead reinvested and paid out along with the principal at maturity. The yield to the investor is higher in such an option because of the reinvestment returns. Apart from a regular fixed interest paying bond, the other types of bonds issued are zero coupon bonds, floating rate bonds, and bonds with put or call options. Convertible bonds allow investors to convert the bond fully or partly into equity shares, in a predetermined proportion. Interest earned is fully taxable. The price of the bonds in the market will respond to changes in interest rates. Secondary market trading in corporate bonds is usually concentrated among institutional investors and the market is not very liquid for retail investors. Apart from credit risk, retail investors also bear liquidity risk while buying these bonds. Investment is subject to underlying risk. Please read all documentation carefully before investing.